the energy market. He's a senior portfolio manager at Ninepoint Partners. Eric, what do you think is sentiment within the oil market right now? Why are we down today?
You bet. Good to be with you, John. I think sentiment right now is literally as low as it was during the COVID demand shock of 2020. When we look at energy stocks, we had 25 stocks make 52-week lows yesterday. Volumes well above average. Relative strength indicators, so measurement of how oversold stocks are, again, are back to COVID lows. And so sentiment today is extremely challenged. It's extremely fragile. I think it goes back to some of the key themes that you referenced. This sector has become not only very, very complicated, but very, very volatile, courtesy of President Trump. We have to, live by our Twitter feed to know whether we're going to have a good day or bad day. The fear and panic is palatable. And I really think it's important to focus around several of the false narratives that are driving sentiment to this low level. One of which is, of course, drill baby drill. Trump wants $50. His ability to create some grand, deal with Iran and Russia, et cetera. And there's just so many fallacies to the narratives that are driving sentiment that I think right now it is critically important for investors to take a pause, take a breath, and reflect on current fundamentals, because they are absolutely not being reflected in either the oil price or energy stock valuations at the moment.
So let's dive a little deeper into that. And I appreciate your comment comparing today to where we were during the pandemic, because we like to explain what's happening in the market, but we also like to talk about whether there is opportunity when people are fearful. And certainly oil prices coming out of the pandemic had a nice run for a few years' time. But if the fundamentals, it sounds like, still are quite constructive to you, can you lay out what those are and what's the disconnect here with the market?
You bet. Okay, so where we stand today is global oil inventories are near their lowest levels in recorded history. That's our barometer for the fundamentals of the market, whether we're over or undersupplied. Inventories have barely built this year when they typically do seasonally. So why is that? First, when we look at supply, the biggest source of supply over the past 10 years has been U.S. shale. It's been more than 100% of all of non-OPEC supply growth. In 2024, U.S. shale grew at its slowest pace since its inception outside of COVID. And so that's not lack of permitting. It comes down to geology. It comes down to capital discipline and the fact that U.S. shale has now entered its twilight. And while it's going to grow at meaningfully lower rates going forward, irrespective of drill baby drill and all of the efforts of Trump. When we look at OPEC Plus, they have laid out for us a calendar to slowly, gradually, methodically return spare capacity back to the market. This is hugely market dependent. They actually went out of their way in the last communique to say that they could actually reverse course. And so I do not think that OPEC Plus members are motivated in any way to want to tank the oil price. And then finally, what gave them the confidence to go ahead with that? I think it's a view that demand growth this year of roughly 1.3 to 1.4 million barrels per day is going to be stronger than consensus. And so you look at it, inventories are very, very low. The largest source of short cycle supply, U.S. shale, is almost coming to an end, and they see this ability to dependent on market conditions, return barrels. But there's just so much volatility, so much bloody uncertainty that I don't think that traders today for oil can express that in going long flat price. They have other more exotic ways to do that. And so we're just in an air pocket right now. We've already seen what is called net speculative length. It's the amount of financial demand for oil come down pretty meaningfully. Safe to say it's coming down in real time now. We just have to flush it out. But in a world where demand's going to grow for longer and stronger, where OPEC has shown not only high compliance and cohesion, but also at a time when they, I think, are aware of the dynamics of U.S. shale and also other non-OPEC producers being challenged, the fundamentals are far, far better than what is being expressed. And so if we apply this to Canadian energy stocks, there's a lot of uncertainty around tariffs. Well, we've done the math. Tariffs under a absolute worst case scenario hits cash flow by 7%. Some energy stocks year to date are down 20%. And so stocks valuations are more than discounting the worst case scenario. We've already heard of gasoline prices in the Midwest, Northeast U.S. rising by 17 cents a gallon. That's a $22 billion hit to U.S. discretionary expenditures. And so we think tariffs are going to be short-term in nature. And even if they're not, stocks are fully discounting it. And given the panic and fear in the market today, you can go out and buy Canadian energy stocks with decades worth of inventory, in some cases low debt or no debt, in many cases all low debt, and they're trading anywhere from 14 to, I'm buying a stock as we speak, trading at a 19% free cash flow yield, and they have like 25 years of stay flat inventory. It's ridiculous right now.
Okay, really helpful context. I gotta squeeze a couple of questions in here. Before I talk more about the Canada opportunity, I just want to talk about the president. And you mentioned every day is a new day, and you never know what it's going to bring. But let's assume that tariffs don't go away across the board anytime soon. While there might be some differences, it's something we're getting used to living with. Some people have raised the concern around the inflationary effects of that. Obviously, on the campaign trail, the president, and you alluded to it, talked about lower oil prices, and that seemed to be one of the things he was considering for trying to address U.S. inflation. If there are inflationary pressures that do come from the tariff story, do you think that could put oil in his direct line of sight? And is that a risk that people have to think about?
Okay, it's a fair question. I would say oil is already in his direct line of sight. He's attacking it almost on a daily basis. But what is in the White House's ability to lower the oil price? Let's talk supply. Where can it come from? It is not coming from U.S. shale. We think shale is going to grow by a couple 100,000 barrels per day in the context of a 105 million barrel per day market. Let's talk Iran and how he wants to use Russia as the mediator for those conversations. Iranian exports officially have already risen by about 1.4 million barrels per day from the Biden lows when they were enforcing sanctions. That's official numbers. Most people think that if you account for ship-to-ship transfers, smuggling, et cetera, that Iranian exports, there are no encumbrances to them. And so let's assume some grand deal gets struck and there is no incremental oil to come onto the market. Finally, Russia and the concerns that they're not going to enforce sanctions, a series of all sanctions. Russia is a member of the voluntary aid members within the OPEC Plus agreement. They are bound to that agreement. And at the same time, what we are likely seeing is an erosion in their productive capacities as they haven't had access to the ability to finance or Western service companies. And so I know it's daily basis. I had to talk to a family member this morning. Forget what you hear, look at what you see. U.S. shale is growing at a fraction of what it used to. Trump's last presidency, it was growing by 1 million barrels per day. Now it's 200,000. That's geology. That's capital discipline. That's maturity of key producing basins. And from a geopolitical perspective, both Iran and Russia do not present the risk to the oil market. Fundamentally, at least, sentiment, we get headline risk, but there's no 1 million barrels per day on the sidelines that it can come onto the market. And OPEC Plus, they are extremely sophisticated. They've shown a playbook that works. And if tariffs impact global demand growth less than what they're thinking, I would fully expect them to reverse course.
Okay. Eric, we have one more question I need to ask you, and we don't have a lot of time, but you've got a lot of people talking about in this era of uncertainty, a Canadian opportunity. And obviously in a sector like energy, there's a lot that Canada can tackle, even if, some would argue we should have been tackling it a long time. You talk to a lot of companies in this sector, sometimes on a daily basis. The politicians talk about being pro-growth or creating opportunity, but the reality is things can't change overnight. Have you heard from any businesses in Canada that are now confident that there will be some meaningful change that allow for the energy industry to get more product to market, to make it as smooth as possible, to actually see opportunity for growth in the country through one of our key industries as a result of what's going on right now?
I think Trump's direct attack on our sovereignty has cemented the conversation around the necessity of building out pipelines. The obstacles to that is our current government and legislation that exists today that effectively prevents the ability to build out more oil pipelines. I remain very optimistic that we're going to have a new government in the next couple of months. They'll be much, much, much more pro-energy. They will, on day one, eliminate legislation that prevents the ability to build out pipelines, either both to the East Coast and the West Coast. And if this actually does become a centerpiece of national urgency, we've got the will, and we now then have the capability to get things done. We could build, an effective Northern Gateway extension off of TMX of 400,000 barrels per day. If you remove the above ground issues and just had to deal with the below ground issues, you could get that built within a year.
Okay. Well, watch closely. Eric, appreciate your thoughts as always. Eric Nuttall joining us from